Usually when a massive health insurer actively plans to shed over 1 million Medicare members, it's panic mode. But for UnitedHealth Group, that's actually the winning strategy right now. Welcome to Earnings Unscripted. Today's July 16th, 2026, and we're unpacking Q2 results for UNH. So Miro, top-line revenue was basically flat year over year, but their adjusted EPS just shot up to $6.38.
Right, massive bottom-line growth on stagnant revenue. They engineered that entirely by optimizing their medical care ratio down to 86.7%, which honestly just means they're prioritizing disciplined pricing over pure market share.
Okay, but look at how the market reacted to that discipline. The stock had a massive run-up during the quarter, gapped up hard this morning, and then just stubbornly faded through the regular session to close down almost 6%. And hey, since we're analyzing some pretty wild price action here, just a quick note that our take today is purely personal opinion, not portfolio advice. But honestly, why completely fade such a strong bottom line beat?
It's a classic case of looking past the headline. Sure, operating cash flow was exceptional, up sharply. But the core commercial health business is bleeding. Costs there are running stubbornly high. And it's largely because a regulatory framework meant to protect patients is just violently backfiring on insurers.
Wait, back up. Are you talking about the No Surprises Act? Because I thought that was supposed to cap out-of-network gouging, not drive up United's commercial trends.
That was the political intent, sure. The reality is a totally different sport. There's this independent dispute resolution process in the Act, and it's being systematically gamed. A tiny handful of entities are dragging United into arbitration over and over, winning payouts that absolutely dwarf standard Medicare rates.
So they basically turned a consumer protection law into a localized profit machine? Okay, I need to hear exactly how 5 groups are managing to successfully shake down the biggest health insurer in the country.
Yeah, it's wild. The No Surprises Act created this independent dispute resolution system, basically an arbitration setup for out-of-network bills, but Den Kueter spelled it out on the call. He said, quote, roughly 60% of all arbitration cases are brought by one of just 5 entities. The average payout from arbiters is now 11 times what Medicare would pay.
11 times Medicare? So these provider groups are just refusing standard rates, forcing everything into arbitration and systematically cashing in.
Pretty much. And Kueter noted it added about 50 basis points to their commercial medical cost trend, which sounds minor, but at their volume, that's an enormous dollar figure bleeding out.
That completely explains why they extended their timeline to hit target margins in the commercial group past 2027. They're basically stuck paying inflated arbitration settlements until the rules get tweaked.
Right. But here's the interesting contrast. While the traditional insurance side is bleeding from this regulatory loophole, Optum is pulling off a massive tech pivot. They took the algorithm they built for internal cost cutting and quietly flipped it into external revenue.
Okay, wait, walk me through that again. Are they selling their internal claims processing tech to rival insurance companies?
No, not quite. They're selling clinical automation to the actual hospital systems. They originally built this algorithm to automate their own prior authorizations, and it got so efficient that it clears 96% of those cases on the first pass without a human touching it.
Wow, that's a massive internal advantage.
Exactly. But Bobby Jindal mentioned they didn't just keep it in-house. They packaged it into a commercial software suite called Optum Real and put it on the open market. He noted it processed 69,000 external authorizations this quarter alone.
So they built the ultimate bureaucratic weapon to defend themselves and then realized they could just rent it out to the hospitals dealing with the bureaucracy.
Basically, yeah. And the time savings are ridiculous because it instantly matches the patient's chart to the insurance requirements. They calculated it saved those external partners tens of thousands of human administrative hours in just 3 months.
That's pure high-margin software revenue for the Optum Insight Group.
Sigh. That's actually brilliant. Selling the shovel during the administrative gold rush. And they're doing it in the exam rooms too. Patrick Conway highlighted their new ambient listening tech. It's active right now in 70% of their Optum Health clinics. It just sits quietly, listens to the patient visit, and automatically drafts the clinical notes for the doctor.
Like a silent AI scribe in the room.
Right. And Conway claimed this drove a, quote, 90% reduction in cognitive burnout for their clinicians.
A huge drop in burnout just by killing the manual data entry, which is a fantastic real-world outcome. But it makes you wonder about the total balance of power here. If they're actively shedding Medicare members to protect margins and taking a beating on the commercial side, can all this shiny new software revenue actually grow fast enough to plug the holes in the core insurance business?
Short term, no, it probably can't cover the whole gap. Software is high margin, but it takes time to scale. And trying to patch a bleeding commercial insurance book is a heavy lift. But management clearly feels the overall ship is stabilized. They actually raised their full-year adjusted EPS guidance to a tight band of $19.50 to $20.
Raising the guide while simultaneously pushing off the commercial margin recovery? That takes some serious confidence. What's supposed to carry them through the back half of the year?
Well, they're relying heavily on Optum again. And there's a slight pothole to watch out for. Bobby Jindal noted that some Optum Health restructuring efforts originally planned for the first half actually slipped into the second half.
So the early margins looked artificially clean, and now they're just shifting that drag into the fall.
Right. It pushes a pretty big headwind into the back half of the year. But the CFO, Wayne DeVette, was extremely definitive on the call. He said, quote, "The quality of earnings is exceptional. The $19.50 to $20 guidance is the right starting point for investors to use as a baseline."
He's practically daring Wall Street to doubt the trajectory. And they're putting cash behind that dare, too. I noticed they doubled their full-year share repurchase target to at least $5 billion.
Yep, they're deploying capital aggressively right now. It really flexes their massive balance sheet compared to the smaller insurers who are just strapped for cash. Plus, long-term, they're completely blowing up the old pharmacy benefit manager model.
Wait, hold on. Blowing it up how? Because the PBM business is a huge profit center for them.
Right, but Optum Rx just committed to passing 100% of manufacturer drug rebates directly to clients by 2028. They're pivoting entirely away from the controversial spread pricing model over to a transparent fee-for-service setup.
Okay, so just to recap, they're purging Medicare members, getting squeezed in commercial arbitration, selling their internal AI to rival hospitals, and voluntarily giving up pharmacy rebate spreads?
Yep, and still printing exceptional cash flow while doing all of it. It's a painful structural pivot, but they're opting to do the hard surgery today.
That's a great way to frame it. They aren't just surviving the regulatory changes. They're proactively restructuring how healthcare makes money for the next decade. Well, I think that brings us to a good stopping point for today. Thanks for connecting all these dots with me, Miro.
Always a pleasure. See you next time.
If this breakdown helped clarify UnitedHealth's quarter, consider making us a habit in your podcast app. And just to pull the curtain back, the two of us are entirely synthetic AI hosts, engineered to parse complicated healthcare filings and, get this, fully generated conversation into your feed the exact same day as the earnings call. We'd love to know what company we should tackle next, so send your requests over to earningsunscripted@datamadness.ca.
See you after the next print.